Hello, I'm Finola Burke from RaaS and welcome to our 2024 Outlook series. In this session, we're focusing on data and insights and analytics business, Pureprofile, ASX ticker PPL. And joining me to discuss the company's outlook for 2024, but as well as its H1 FY24 revenue and EBITDA is CEO and Managing Director Martin Filz and COO and CFO Melinda Sheppard. Welcome, Martin and Mel, thanks for joining me.
Hey, Finola, thanks for having us.
Yeah, thanks for having us, Finola.
So, Mel, I'm going to start with you. Pureprofile delivered H1 revenue of 24 million, up 8%, and EBITDA was 2.4 million, up 6%. But if we do a like-to-like comparison, EBITDA was up 21% and the margin was 11.5%. The result was driven by very strong growth in the SaaS platform and expansion globally, which has been a theme for the group for the past 12 months. Do you feel that the growth demands of the business will allow you to also deliver NPAT profitability in FY24?
Great question. Now, it is an absolute key milestone for the business is for us to be NPAT positive. It's something that Martin and I have been working, and the rest of the business too, have been working towards for the last couple of years. So the first point is our investment philosophy hasn't changed. It remains the same as it has always been, and that's really about disciplined investment, which allows us to grow the top line revenue and continue to grow the bottom line. And that's the trend that we've had for the last couple of years. When we put our audited results out, when you can see the NPAT number, you can see that the loss has declined year on year. And so that investment philosophy served us really well, and we're continuing with that today. When we look at the first half of the year for last year, for FY23, the business actually made an NPAT loss of $500,000. If we kind of think about what we've done over the last 12 months, we've closed two businesses with our Pure Amplify Media business that were unprofitable. And we've also continued to invest in global expansion, which has obviously helped us grow that top line. And we've also been focusing internally on our own efficiencies with some of the AI tools that we've rolled out internally. So all of those factors and initiatives that we've had with the business can continue to help us move towards that NPAT profitability. So we will be putting our audited half-yearly results out towards the end of February. And what I would say is I'd expect to see the same trend continuing, where you'll see a significant improvement in our NPAT.
Thanks, Mel. So, Martin, the growth in revenues in the platform business was particularly strong, up 104%. How much has the investment in generative AI underpinned this growth?
Yeah, so good question. Look, generative AI is the hot topic, right? Everybody's talking about it. And funnily enough, we had the executive team and others got together. We did a strategy session in November for looking at the next 3 years. And our CTO, John, is fantastic. About an hour in, said, okay, everybody, just stop talking about generative AI. We have opportunities and problems in the business, and that's just a tool amongst others that may be used to solve those problems or deliver on those opportunities. And that's very much how we look at the business. So as Mel just said, we've had continual improvement, continual margin expansion since I joined 3.5 years ago, and we started working as a partnership. And so that's just continued. And generative AI didn't exist a year ago, but we've implemented other things that have enabled that. Certainly, there are a number of opportunities with AI. And we put in place back in last April now, David Wooten, who's our head of AI, and we made a call on that because there's so much information about latest releases, latest products, opportunities, etc. And we brought in, David Wooten was in the team already, and we made him head of AI. And he's like a filter for us and looking at opportunities and where it can roll out. And certainly in the last 6 months, we've rolled out a few internal AI solutions that have delivered efficiency, speed for clients, quality, improved quality where necessary. And that has helped that margin expansion. We've got a number of other internal solutions that, again, will with AI and without AI, that will continue to help efficiency. And then moving forward, looking at external client solutions. The big growth in platform has been a very conscious one. So working with clients so that they can bypass the manual processes, bypass the people, and actually directly access our panels. And in actual fact, Mel was sharing in December, a new client came on board, and they were our second largest client in December, and that was 100% on platform. So that's actually, as I said, not to do with AI, but just consciously working with clients, showing them the benefits of working with platform and increasing usage. It increases margin and efficiencies.
And Martin, the international operations benefited from the investment in India, Southeast Asia and the EU. How are you finding business conditions internationally, and has the broadening of operations across a number of jurisdictions helped?
Yeah, so if everybody remembers back, that was back in Q4 23 that we made that additional, actually Q4 22, I think, that we made that additional investment. And so during 23, at the early part, we saw that investment as a cost. It's now paying off, and we made an announcement, wasn't an ASX announcement, but a PR announcement that we've hired people now to head up Germany, Austria and Spain and Portugal, so expanding our UK operations. And as we saw during Q1 and Q2, our expansion and our growth in overseas non-ANZ business has been consistently more than doubled. And I think now it equates to about 42% of our global revenues versus 3.5 years ago, it was in the 20s. So fantastic to see, and you are 100% right. It enables us to have lots of levers. So we've got product levers that we have a number of products in different countries and different offerings to clients. So one can be doing well, another one we've actually got to put more resource in, and you're pulling different levers and recognizing growth and investment. We've got geographical locations, so that's fantastic for us. Australia, we saw the inflation numbers came out yesterday, and certainly Australia is a tough market at the moment. But guess what? The UK is now coming out of their downturns. We're seeing investment in there. The US, end of Q2 for us was their Q4. Guess what happens in Q4? Clients spend more, clients invest more to get over the line for a strong finish to the year, or maybe spend budgets so they get the same budgets next year. So we've got all different seasonal input, different rhythms going on around the world, and it's fantastic. You know, I said a long time ago with you, I'm so pleased we're not a company that just works in Australia and we sell baked beans. Because if people don't want to buy baked beans in Australia, we're in trouble. Whereas we're a global company offering numerous data solutions to different clients. And now there's, close to 800 clients around the world. So I was on with head of Europe and the US last night, and we were talking about that. And he said, I'm gunning for Anna, and Anna heads up our Asia Pacific business, because he's getting close. And we've also said that another goal for us is we will see international overtake Australia from a revenue standpoint. And that's something, again, we're heading quickly towards. And then the next goal after that one we've already got is the US to overtake Europe. So we're getting there. So touch wood, everything so far that we've done over the last 3.5 years, as Mel talked about, has come to fruition, and the investments have been the right ones.
And Mel, you've finalised the refinancing of the facility in November. What would we expect from interest costs going forward, and how are you viewing the balance sheet?
Yeah, great. Yes, we did finalise the refinancing in November, and we're really pleased to announce that we've moved to a Big Four bank away from a debt fund, which is where historically the company has sought funding from. Obviously, when we took out the loan previously with Altor Capital, that was a very different interest rate environment back in 2020. Things have changed a lot now. Our new facility has a line fee of 4.2%, and then we have an interest rate tied to the bank bill swap rate. So it's likely overall to be about 8.5%. Obviously, it'll move around a little bit when that bank bill swap rate moves around a little bit. So that's going to be broadly in line with the interest rate we were paying with Altor over that 3-year period. I think the key difference is if we'd stayed with a debt fund, we know that we were likely to be looking at an interest rate of around 13 to 15%. So over the 3-year period, by moving to one of the big four banks, which is CBA, who are our current bankers in Australia, it's likely to have saved the company $600,000 to $700,000 in interest rates. So it's quite significant and a really great win for our shareholders, I think, from that perspective. Another difference with this loan facility as well is, given the company has got strong operating cash flow, we are now going to be making principal payments on that loan. So that will actually help to bring the interest rate or the interest payable down over time. So we'll be making quarterly payments of $50,000 to get that loan down over the next 3 years. And so that's fantastic from that perspective. So that change in, I suppose, funding means that the interest rate or the interest expense will be broadly in line and coming down from what we have been paying. So that's a win-win. And obviously that will actually bring down that liability on the balance sheet. Now that liability now, obviously, is because it's been renewed, is now not a non-current, or it's not a current liability. So our balance sheet is, looking a lot stronger than it was while it was sitting as a current liability on our balance sheet. So we've got strong positive net assets that everyone will be able to see when we put the audited results out at the end of February. We've got good, strong cash balances. And given this improved EBITDA position, that's going to continue to build over time.
Just really quickly, just to add, like, Mel's incredibly modest, but that was 9 months of work to work with CBA and to get the refinance, which we've done. And again, to the wider team, we did a 8-for-1 debt to equity swap 3.5 years ago, and in 3.5 years we're able to get finance from a top 4 bank. There are very, very few companies of our size that are able to go to a top 4 bank to get finance in that way, versus having to get finance in other ways or do capital raises or whatever it is. So again, it's the testament to Mel and the team, and equally the wider team of where we've come and where we are today as a business.
Oh, absolutely. And Martin, you've reiterated your guidance for FY24. How confident are you of delivering within that revenue and EBITDA margin range that you provided to the market? And what could upset it?
Yeah, well, look, as we said, we reiterated the guidance. Everybody can see our numbers, work out what the remainder of the year looks like for us, and can come to the same range, which says we all feel comfortable today that the guidance is the right guidance. We've definitely seen a slowdown. We had 16% growth in Q1 and 8% growth for the half, so it shows that there's a slowdown for Q2, but that was specifically in October. We saw coming back in November, and then December we're back to full growth. And again, where we forward see, and hence why we're able to see guidance, and also we finished January yesterday, but where we're able to forward see and forecast, we can see the order book is looking strong, we can see bid levels are strong from clients. And again, back to that earlier point, the international markets, whilst Australia might have slowed down, are equally coming out of their challenges that they had sort of a year, 18 months ago. So comfortable with that. Look, what can derail us? Of course, Australia has more of a slowdown. We're number 1 in Australia as a company in our vertical, and we see a slowdown in the rest of the world. Escalations on awful conflicts that we have around the world at the moment, as well as a spike again in inflation. But as Mel talked about earlier, we're really prudent about our investments. We've never invested ahead of the curve. We've always invested to look at a ROI on people that we've added in place. We have really good systems on board and analytics that enables us to look at workloads and per person, etc. So this is all the planning that we do. And as I said, having Mel looking after purse strings and being absolutely prudent as an organisation.
Well, thank you, Martin and Mel, for joining me today to discuss Pureprofile's revenue and EBITDA announcement and the outlook for 2024. I'm looking forward to catching up with you through the course of the year to check on the company's progress.